Over the last decade, I've helped to fund hundreds of clients' development deals. The other day, I had a really interesting conversation with a client of ours who was experienced and had been doing lots of developments with us before. And we came across a word that he didn't know what that actually meant. And I thought to myself, how many people out there are watching these videos or videos like that and don't fully understand all of the terms? So I thought I would make a simple video going over all the basic terms that you need to know when talking about development finance. The first phrase is loan to value. This is probably something you've come across before if you've purchased a property or looked at ever purchasing a property or getting a mortgage for your own property. Loan to value is simply the ratio of the loan amount that you can get on a property against the value of the property, and it's typically expressed as a percentage. So for easy numbers, let's say you're able to borrow £70,000, the house is worth £100,000, so it is 70% loan to value. The simple way to work this out is literally loan divided by property value times by 100 to turn that into a percentage. The reason why loan to value is actually important, it determines how much you can borrow relative to the property, and it impacts on the perceived risk of that particular deal, thus impacting on things like the rate that you can get. Gross development value, or GDV, it's a very similar principle to loan to value, but it is expressed the loan against the end value of a property. So let's say you're building a property from scratch, you'll have the land value initially, but what the gross development value is the property value once all of the work has been completed and the house is finished. Again, lenders use the GDV to determine the profitability of the deal, how much return on investment you can get, that thus impacts on what they can offer rate-wise, etc. Another term that you may come across is senior debt. This is very simple. It's the primary loan taken out for a development, usually secured against the property that you're developing. Then we've got mezzanine finance. This is a secondary type of loan used to cover the shortfall between the senior debt and the funding requirements. Mezzanine finance is an important aspect of development finance, but typically kicks in on much larger deals. Another term that you will come across often is bridging loans. Many of the smaller development loans actually are made up of several small bridging loans. So a bridging loan is typically a short-term loan that's used to bridge the gap between purchasing a property and securing a long-term finance. But when it comes to development loans, they can do several small bridging loans that bridge the gap between one point of the property schedule, as in the development progress, and another. Bridging loans are typically outside of the development space, used for quick capital, and they do come with higher interest rates. Then we've got planning gain. This is the increase in the property value once you actually obtain planning permission for a site. We've just got a 1 acre field of land that is used for grazing cattle. That typically is valued at about £10,000 per acre. But if you then go and get planning permission on that same plot of land for 5 houses, that plot of land value will increase drastically, because now it has more intrinsic value to developers who will want to buy that land and then develop it and make a profit off it. So that difference between what that land was worth and is now worth is called a planning gain. Another term that a lot of people don't like to hear, but if you're lending money in a limited company, you will almost certainly have to do this, is a personal guarantee. It's a legal promise from you, the developer, or the business owner to repay the loan if the project fails. Most lenders will require a personal guarantee as extra security, especially for the higher risk loans. There is some actual insurance that you can take out to cover the risk of a personal guarantee, but that's going into the weeds a little bit, so we'll cover that another time. After that, another key thing to know is what your exit strategy is, and you'll hear the term exit strategy a lot. This is very simply a plan and how you will repay that development finance. Typically, this is either selling the property or refinancing the property. Having a solid exit strategy in place reassures the lenders that you know what you're doing and that they'll be able to get their money back. Interest only. On some of the loans that you'll be paying, you will need to service the interest monthly. This doesn't happen that often in development finance, but it's a good term to know. What that simply means is you only cover the interest portion of the loan rather than any capital, so the main principal debt never gets reduced. You pay that typically off in one lump sum at the end. If you are looking to service the interest on a development loan, why this is important to know is that you need to actually be able to manage your cash flow as the build goes to include covering the interest. Then you've got drawdown or tranches. These are simply the release of loan funds in stages as development progresses. This ensures the funds are available when needed and that the lender only releases money based on certain milestones that the project hits. So the drawdown of the funds is an important thing to be aware of, because you need to know when you're going to be able to request that money for your next stage. Cash flow is really important on the development, and if you time that wrong and you aren't able to draw down a loan when you need the money, it can severely impact on your build. Then you've got development yield. This isn't something that you smaller developers will come across too often, but it's a good sort of term to know. It's basically the annual return on investment from a development project. It's calculated as a percentage, and it can help measure the project's profitability and financial viability. This is generally more important if you're going to be holding it for a longer period of time. The next one is equity contribution. This is probably the bit that most developers struggle to get to, because it is counted as your skin in the game. What sort of cash have you actually got to invest into the project at the start? So this is your personal wealth, or the business's wealth, going into the project. Most lenders will actually often require a minimum amount of equity contribution to reduce their risk. This can come in the form of either cash or the equity that's built into the plot of land initially if you don't have any debt on the side. Then we've got cost overrun. This one is a word you hopefully don't come across too often, and it basically means that additional costs that you've incurred during the project when it exceeds your budget. It's important because cost overruns can significantly impact on your profitability, so it's crucial that you have a contingency plan. Another interesting term is pre-sales and prelets. These terms are probably the best terms you can hear as a developer if you manage to get them, because this means that you've actually secured a buyer or a tenant for that property before it's even completed, thus the pre-sales or pre-let. This helps reduce the risk, so it will help you with the exit loan if you need to, as well as if you've got it even in place before the project starts, it will help with the development finance too. This one's maybe a little bit technical, but it's called capital stack. This is simply the hierarchy of financing used for the project. So this will be senior debt, mezzanine debt, equity. And that will be typically the order, if things went wrong, that the loan will be paid back in as well. So first charge, senior debtor, second charge, mezzanine funding, and then third, equity. They're the three major points. It's useful to understand this because it clarifies the risks of each portion. Then we've got a cash flow forecast. This is also known as a build schedule, property schedule, development schedule, all of those sort of terms. They're essentially the same thing. It's a projection of the inflows and outflows of cash over the course of the development. Typically, there's only outflows. It's important that you do as accurate as possible cash flow forecasting, as it can ensure you meet your financial obligations and avoid running out of funds mid-project. The next point is contingency. We've actually mentioned it a couple of times already in this video, so it's probably important we go through that. It is the amount that you can set aside to cover any cost overruns. Most lenders will often require a contingency budget to be built in, and this just avoids any financial shortfalls that they have to then bear. Refinancing. This is very simply replacing one loan with another loan. Typically, you're doing this so you can go from one set of terms, that is the development funding, onto a more long-term loan, which will come with better terms, better rates. You can refinance as well, not just to replace a loan, but also to raise capital and release equity from the property. A lot of the developers we work with, they own properties and they will refinance, aka pull money out of those properties in order to go and purchase other properties that they're looking to buy, and sort of cycle the money that way. So as they sell the new build, they then pay back that debt and they just pull it out every time they find another plot. So refinancing is a really important tool in our arsenal to help you get further on with your development builds. Then we've got the development finance broker, aka what we do. This is typically a specialist who can help you find the most suitable finance for your development project. It's fairly simple. They'll run you through all of the processes. They'll help you sort of liaise the maze of jargon in order to get you what you want. Having a broker on your side is incredibly useful because they will have a very wide network of lenders. They can negotiate on your behalf. They'll do all the hard work for you. They'll organize all the terms. They'll liaise with the lender, negotiate terms for you. Their whole job is to make things a little bit easier for you. Then the last term that you're likely to come across is retention. This is something that I know bothers quite a few of our clients, and that is when they're getting a drawdown, there is occasionally some money held back from that drawdown. The reason why this happens is typically because there's been an agreed milestone that you have to hit in your build, and you may not have quite hit there. So what they will do, rather than not sending you all the money, they will send you the money for the things that you have done and then retain a small portion of that funds so that once you do get that, they can then release it to you once you've hit the milestone. The retention just ensures that the developers or the contractors deliver the project to the required standard of the lender, which is fairly obvious, and you will come across it occasionally. Some lenders build in a retention to every drawdown just by default so that they build up a contingency for you. One of the lenders we work with often does about 5% of each drawdown. It isn't significant enough to necessarily hinder the development, but it gives you that buffer at the end that if there is an overrun, they've got 5% left over at the end just to give you that cash. So these are some of the keywords that you will come across. If there is any other terms that you'd like us to cover or you aren't sure what they mean, just drop them in the comments below. If you found this useful, share with any of your friends, any other developers you know, and I hope this helped. Thanks so much.